Welcome to another episode. My name's Jose Najarro, and today we're going to take a look at Amazon. So let's get started. Amazon just reported earnings today after hours, January 30th, 2020, and the stock is almost up 10%. It is all the way up to $2,053 compared to closing at $1,870. So today we're going to take a look at this company's slideshow that they provided during earnings. They also provided with some form of like a shareholder letter which provides some more information. And we're also going to take a look at some news that come from Seeking Alpha just to see what's happening around with Amazon. Okay, so first, Amazon. The main reason this company is up about 10% is Amazon beat earnings per share and beats unexpected revenue. GAAP earnings per share were $6.47 and it beat by $2.51. Revenue was $87.4 billion and it beat by $1.35 billion. Revenue is up about 21% year to year. So these are some great growth. It's crazy to see. We saw yesterday Facebook, and today we're seeing another giant, Amazon. We saw Microsoft. All these companies, which are titans, still are able to produce double-digit growth on revenue. And that's actually pretty impressive in my mind. Next, let's take a look at how that revenue is broken down and how it compares to what was expected for this company. First, let's just break down the segment revenue for this company. It's broken down into three sectors. The first sector is North America, which takes up a huge portion of this company's revenue. The next is international, and the final is AWS, which is Amazon's web services. Then if we break down, so in all those segments, Amazon beat in every form of expected. It beat North America. North America produced $53.7 billion, expected with somewhere around 52.6. International was 23.8, and it was expected to be 23.4. And web services was 9.95 billion, and it was supposed to be 9.8. So we see they did better. They beat on all expected segments of their revenue. All right, so next we're going to take a look at the business segment. This company has 5 business segments: online stores, physical stores, third-party sellers, subscription services, and others. And most of these actually beat or were pretty flat or met expectations. Online stores kind of met expectations. They beat by 0.01 billion. Physical stores actually missed expectations by $0.01 billion. Third-party seller service is a big beat. They beat by about $1 billion. Subscription service beat by $0.02 billion. And others beat by $0.2 billion. So we can see their business segment, everything met as expectations. There's not one except the third-party seller services that beat expectations by a big margin. Finally, the last thing I want to take a look at is how this company's forward PE ratio is looking at. This company right now has a 27 earnings per share estimate for December of 2020. So that gives this company a forward PE ratio of somewhere around 68.71. Out of all the companies that I feel I've done this week, Amazon is definitely the most expensive out of all of them when we take a look at its forward PE ratio. But when we take a look at the forward price to sell, this company for 2020 has a forward price to sales ratio of 2.77, which is actually a pretty low number in my opinion. All right, so here we are in the financial slides that this company provided during their conference call. I highlight some of the information. We're not going to go through all the slides, only the ones I thought were interesting to read about. And then we're going to take a look at some more information this company provided in their earnings. So the first thing we're going to take a look at is the free cash flow from the trailing 12 months of this company. In quarter 4 of 2018, for the trailing 12 months, this company had about $19.4 billion of free cash flow. Now this company is sitting at $25.8 billion of free cash flow. So we can see that growth of 33% year to year. Within this free cash flow, they also make a statement that operating cash flow grew about 25% year to year. So we are seeing these double digits, which I think is pretty impressive. The next thing I wanted to take a look at is the shares. Again, it's so crazy, right? Seeing the different giants and the different players within this earnings. Most of the time, we see these big giants buying back shares. Amazon right now does not have a strong shareholder return buyback program, which I think in their mind is they still believe that they can continue to grow, so they keep all that earning to make sure they continue to develop and continue to grow, which is not a bad thing. But I just wanted to show out there. Same time last year, quarter four of 2018, they had about 507 million shares. Right now, here in quarter four of 2019, they have 512 million shares. So, and they increased their total shares by about 5 million shares. Next, let's take a look at net sales. Net sales for this company last year, quarter four, was $72 billion. This quarter was $87.4 billion, a growth of 21% year to year. And like I mentioned, like I keep saying, seeing these double digits is impressive. Next, let's just take a look at the trailing 12 months, which is pretty much just the fiscal year of 2018 and 2019. So for the full year of 2018, this company made $232 billion. In quarter four, it made $280 billion, an increase of 20% year to year. So the full year, it grew, like again, that double digits, which is pretty impressive. Next, if we break down the company's total sales, 61% of the sales come from North America, 27% come from international revenue, and 12% come from the web services. So it's pretty crazy, right? How North America is such a huge player of this company's net sales. Next, let's take a look at operating income. Operating income grew only 2%, which I thought was pretty a letdown compared to the amount of revenue they grew. I would have expected operating income to grow at a higher pace as well. But we only see a 2% year-to-year growth on quarter operating income. Quarter four of 2018, this company had $3.7 billion of operating income. This year, they had about $3.8 billion of operating income. Operating income for the full year of quarter four of 2018 was $12.4 billion, and operating income for 2019 was $14.5 billion. So here we did see a nice 17% increase year to year on full year operating income, and this is what I wish we would have seen in quarter four. But I wonder if quarter four was just they had a lot more expenses to pay off. So now we're going to take a look at segment results for North America. Here in North America, compared to the same time last year, sales are up 22%. So sales last year were $44 billion. Right now they're sitting at $53.7 billion. So we did see a huge increase in sales, but unfortunately we saw a decrease in operating income. It's down 16% year to year, and that's actually pretty weird, right? Why would you have an increase in sales but make less money? And this is something that in further episodes we probably dig in to see what's really happening and why this company is losing sales on more revenue. Internationally, this company made 14% more sales this year when we take a look at the international for quarter four of 2019 compared to quarter four of 2018. And still, this company is providing operating loss on their sales. Even though the sales decreased a little bit, this company still this quarter produced $617 million loss on their revenue collected from international results. Finally, one of my favorite segments from Amazon, which is one of the biggest money maker for Amazon, is sales. So sales is AWS, the Amazon Web Services. Amazon Web Service grew 34% year to year when we take a look at quarter four of 2018 to quarter four of 2019. And operating income grew 19%. Operating income was $2.6 billion in quarter four of 2019. 2.6. And operating income for North America was 1.9. So this company, look, so this is what I think is pretty crazy. So it's actually a good, if this company continues to improve its AWS, it can continue to make better operating income. But out of $53 billion sold, this company only made $1.9 billion. So $53 billion to 1.9 out of $9 billion, out of $10 billion that this company sold in AWS, it made $2.5 billion, right? So it's 5 times less the sales, and more than 1 times greater the operating income. So AWS, if AWS continues to grow at this double digits, we're definitely going to see this operating income of AWS continue to rise higher and higher. All right, so that's it. That's all I have from their slideshow. Now let's take a look at this company's information that they provided to us. All right, so some of the stuff here might be a little repetitive, but it's still good to note, right? To remember these, so we, like that when we take a look at this company again, we know what we're looking at. Now taking a look at the full year of 2019, this company's net sale increased 20% to $280.5 billion. This company is making huge amount of sales. This is ridiculous. Operating income increased to $14.5 billion to the year compared to $12.4 billion last year. So we do see that increase in operating income, and net income also increased to about $23 per share compared to $20 per 14 cents last year. So we saw about $3 per share increase in net income. And normally I try to look at the actual value of net income, but this company has about the same amount of diluted shares as it did last year. So looking at per share basis is actually a very easy way to actually see how this company is growing. Bezos talked, and he did say that more people joined Prime this quarter than ever before, and they have now over 150 million paid Prime memberships around the world. And the number of items delivered to US customers with Prime's free 1-day and same-day delivery more than quadruple this quarter compared to the same time last year. So this company is definitely working to make sure that its customers are getting the best services that they can provide. And just a side note, Amazon is not a company that I have personally, and at the moment I don't know if I will build a position in this company, but I just like looking at where these companies go. So if the companies ever do drop or ever give me a really nice entry price, I know right away that I can go and jump in because I already know what's going on with the company. This company then produces all these highlights that I'm not going to bore you with, but it tells you about all the things that this company is doing. There's over 30 somewhere bullet points. So yeah, feel free to go take a look at them if you guys want to. I'm still scrolling. The only thing I'd like to see is, I did not read them, but I do see a lot of AWS, Amazon's Web Services, highlights, bullet points going on. I haven't read most of them, but I do see a lot of them, and that's good because we saw, right, AWS has such great margins compared to the rest of the company. For the first quarter of 2020 guidance, they expect somewhere between $69 to $73 billion, which is a growth of 16 to 22%. Again, we continue to see that double-digit growth. Operating income is also expected to be somewhere between $3 billion to $4.2 billion compared to $4.4 billion this past quarter. So they are seeing a little bit less in operating income this first quarter compared to quarter one of 2019. But they're saying that they're expecting to do lower depreciation expense here in this year. And we're going to see one thing they did do this year heavily is they were depreciating a lot of their assets, which at the end of the day help increase that operating income. So here they're going to do less depreciation, so they're going to have less added to their income. So the first thing we're going to take a look at is this company's cash flow. So cash flow from 2018 compared to cash flow 2019. The only true cash flow I really care about is net cash flow from operating activities. This is the positive cash flow that this company collects from its everyday business use. So in 2018 quarter four, this company had $16.5 billion of operating cash flow, and right now it's sitting at $19.6 billion. So about a $3.1 billion increase in operating cash flow, and that's really great to see. The next thing I want to show you is that this company looks like it collected some proceeds. It took a bit of long-term debt. It collected this year positive about $1 billion of cash from a long-term debt, and it paid off about $1.8 billion of a long term. So this is repayments. So the first one is them collecting some form of or taking out some form of loan, and the second one is repaying back some kind of loan. So we did see that they took out a little bit more of a loan that this quarter compared to the same time last year. but they also paid back a huge amount of debt this quarter compared to the same time last year. So this quarter, 1.8 billion compared to the same time last year of just $0.1 billion. 0.1, not one, so just 0.1. So they did increase their repayment by a huge amount. All right, so next we're going to take a look at this company's income statement. So income statement, we already talked a lot about their sales, so let's not take a look at their sales. I really want to take a look at their cost of sales. So actually there's something I do want to mention right in their sales. So sales for this quarter grew about $15 billion. Grew about $15 billion, which is pretty impressive compared to the same time last year. Their cost of sales grew about $10 billion. Their total operating expenses grew about $15 billion. So their total operating expense grew about the same amount of total net sales grown. And that to me is something I don't like to see, right? So this company is actually, if this company sells $1, it took $1 for this company to make that sale. And that's not something I like to see, right? So remember, we saw a $15 billion increase in sales for this quarter, $15 billion increase, and we barely saw $100 million increase in operating income. And it's because that total operating expense has increased dramatically. The main culprit being cost of sales. But one thing I do see too is marketing. They spent a lot more money in marketing this year compared to the same time last year. This year they put $6.1 billion in marketing, where last year they had 4.9. So I'm going to give it to them. It's pretty smart that they use more money for marketing so they continue to grow. And maybe that's why we saw that this quarter was the best Amazon Prime quarter of growth in Amazon Prime members ever. But yes, this is something, I mean, look, total net sales for the year grew about $50 billion, and total operating expense grew by $45 billion. So again, $50 billion increase for the whole year in sales, but operating expense grew by $45 billion. So they're barely making any money on their sales. And that's the only real thing I complain about. But at the end of the day, is that they're trying to just get the members and these customers. Once these members sign up to like Prime member and everything, the revenue just keeps coming in with less cost of sales. And that's what Amazon is trying to do. Here we're going to take a look at this company. We already took a look at the weighted average shares, but basic shares 496 and then 496 million this quarter compared to 490. So we saw about 6 million increase in basic shares. All right, next let's take a look at this company's balance sheet. And if you guys have watched my show, this is my favorite statement to take a look at because you can definitely see what this company is doing here. So cash and cash equivalents grew for this company about $5 billion compared to the same time last year. Marketable securities grew about $10 billion. So it's sitting in $36 billion in cash and about $18 billion, almost $19 billion in marketable securities. So these are great numbers. Inventories did grow about $3 billion, but that's not much compared to that cash and cash equivalent growth and that marketable security growth. So this company has about, what I would consider cash, has about a little bit over about $55 billion in cash. For this company has total current assets of $96 billion compared to the same time last year of $75 billion. And the biggest things were that cash and cash equivalent increase and that marketable securities increase. We also see an increase in accounts receivable, right? But that is to be expected. Accounts receivable is money that this company needs to collect from its customers. And if it sold more revenue, the chances of more money being owed to them has also increased. So that makes perfect amount of sense. Next, we're going to take a look at the company's total assets. This year, this company has a total asset of $225 billion. But one thing we take a note here is this company is now reporting. It has to report. It's not by choice. It's not because it did it. It has no choice. It's reporting a new assets that increased the total assets by 25 billion. So if we want to compare apples to apples, the true total assets is about $200 billion compared to the $162 billion last year. So again, we see this company increase total assets, and the biggest 20 billion, it was about a 40 billion increase in total assets. About 21 billion came from total current assets increase. The next came pretty much from property and equipment increase. Next, let's take a look at this company's current liability. Accounts payable increased about 10 billion, so from 38 billion last year to about 47 billion this year. But again, just like accounts receivable, this company provided a lot more sales, so it needed more products. So obviously it had to buy more products this year compared to the same time last year. So that's okay to see accounts payable increase like that. It also had a huge increase in accrued expense and others. So these are just expenses that it has not paid off, and it just continues to build it up and build it up. And that increased about $10 billion. And that's why total current liabilities grew about 20 billion this year compared to the same time last year. Right now sitting at 88 billion compared to 68 billion same time last year. But we saw a 10 billion increase in accounts payable and 10 billion increase in accrued expenses. Next, long-term debt. This company has $23 billion of long-term debt. And this is what I like. I like this a lot because that means this company has enough cash to go off and just pay off its total long-term debt. That's what I like to see. I like when quick current assets, when very easy liquidizable assets can come and pay off this company's total long-term debt. So that's definitely a good thing. That I really like the company's balance sheet. So that's it. That's all I have. So let's do a quick recap of what I think Amazon is doing. First, let's just go back. Their balance sheet is pretty amazing. I really think their balance sheet is pretty good. They have plenty of cash and they have very low debt compared to the amount of cash they have. Their income statement is also pretty good. They are increasing their sales by double digits this quarter and by the year. And this upcoming quarter, they also are increasing it by double digits. That is a good thing. Unfortunately, the amount of money they make by these sales is pretty much almost nothing. So they pretty much end up with the same operating income. When we took a look at their segment, we saw that AWS is one of the biggest, the ones with the greatest margins, making the most amount of money with the least amount of sales, which is pretty impressive. So I'm happy to see that AWS will also continue to increase. When we were looking at some of the highlights, AWS had multiple points. So we know that AWS is going to continue to grow and continue to help this company provide even greater operating income. And I do think at the end of the day, the operating income from AWS is going to be the true winner. But like I said, I don't like how the rest of the margins look for international and North America, right? We saw international being a negative. This company is actually providing a loss on its revenue from international sales, and it's making very little money in regards to proportion with its everyday sales. But as a retail store, right, even though this is as an online retail store, this is expected, right? You would expect to make low operating margins on sales, which at the end, I understand why those margins are low. So it's understandable, right? Next, we saw what else did we see? This company has no shareholder buyback program or anything. It's not returning to the shareholders. It believes that it can continue to do better in its company and continue to invest in its company and keeping all its money, which again, to me, it's 100% okay, right? If this company believes it can make more money with its money, then go ahead and do it. And that's the way you're going to return to your shareholders. We also saw this company do more money on marketing, which to me, for a company like this, is the equivalent of research and development. So again, that's also looking good. The only thing, one thing I kind of didn't like was the forward PE ratio for this company is pretty high. I think 68 just for me, right? For each investor is different, and I can just miss the biggest wave ever. But for me, I feel like I can find better valuation in some other companies. So I don't say Amazon is a bad investment. It's just not my investment at the moment. But a forward PE ratio of 68 is kind of high for my taste. But I hope you guys enjoyed this episode. Make sure to subscribe. Make sure to share it. And next, I'm going to take a look at, I'm not sure what company I'm doing next. Either, I think it's Visa, actually. Visa. And then I might do EA Games because I really want to do that. So take care, guys. Have a good night and see you next time.